Right, for anybody? Currencies. Yeah, Forex is a different monster. Um, we can Bitcoin. You can trade like a stock if you want. There's a lot of different things that you can do with that. Um, but if you want to look at currencies, we can do that. We can look at currencies. Uh, it's not bad to look at currencies. I can show you. I'll show you just a Skeleton account. Hold on. So it pops up. I'll show you Forex. And let's see if we can do something with that. Hold on. One sec.
Incoming mail.
One second, folks. I'm just setting it up. One sec, folks. Sorry about that. Sorry about that. I'm trying to set up a demo account that we can use. Apologies for that. One second. Sorry about that. You can ask me questions while I do this. I'll put you over here where I can see you. We can actually. Why don't we do that? Actually, let's. Get this working. Sorry, folks. Sorry about that. You know what? I will have to set this up on the next call. I'm thinking of having 80% dividend focus on and 20% short-term stock. Okay. Okay, wait, no worries. Did you ever jump into cryptocurrency? I'm not a fan of crypto, but I mean, that's totally up to you what you're looking for. At some point, we could talk about all this reinvesting dividend plans. What do you mean, Rodrigo? I'd like to hear that too. I'm thinking of having a meeting, but this might change now because of the situation. I missed the last two calls. I don't know how we are. Some companies stop paying dividends. So your dividends, you're looking for companies that pay dividends. Is that what you're saying? So that's called a drip. You're buying more stock with the dividend that you get. I'm not a fan of that personally, just because if you're not taking anything out, you're buying more stock. There's got to be a point where you take money out of it. Like there's or you're putting that capital at risk. I think at least take the dividend out. I'm not a fan of putting it back in, but I mean that's me. Um, when you get into a trade or you get into a business or even a property, I think at some point you have to have a plan when you're going to sell. Um, there has to be a point, I think, ahead of time that you want to make sure that you're putting yourself in a position to capitalize on what you trade, right? What you actually trade. So I think that simply buying stock and holding it with no plan and keep the dividend drip, just going back and buying more stock might be difficult. To like, what do you do? When do you sell that? When do you sell that? When's the right time to sell that? That's I'm not sure. I mean, if you're holding it for the dividend and you're getting money that way, I get it. Um, if that's what you're looking for, um, that's totally up to you. If you're buying it, like, what are you buying it for? I guess is the question. What's the point of you know the buying? I guess is what I would ask you. What are you hoping to gain from investing that way? I think knowing covered calls now makes dividend game looks easier. How do you mean, Henry? I think knowing covered calls now makes dividend game look easy. So, you mean invest for dividend and then run covered calls on it too? Is that what you mean? Right. I mean, if you're gonna hold a stock, I think it's a good idea to at least try to pull or extract more from it through covered calls. Um, a lot of people, because options are so big right now, and there's a lot of volatility. The option prices are pretty good, so doing covered calls can make you some good money. Uh, which stocks that covered those two? Which stocks that covered those two? Wait a minute. uh, that if I hold the company for at least say 5 to 10 years and the dividend increases, I will take in, let's say, 70% of the dividend and reinvest 30%. And at the long run, if only if the company was doing great, sell it. So, okay, so there's a couple challenges, that you got to deal with, Rodrigo. One is if the company's doing well, then the company's doing well. Why? At what point would you sell it? What price is the right price for you to sell it? See what I'm saying? What would would you have a price in mind? Would you have a plan? And if the company was doing poorly, would you just hold on to it? I think the thing you want for sure is a plan, right? I think to be safe, you'd want to plan ahead of time. I think that's some of the problems that we have um, when we trade. If we don't have if we don't have a plan, then it becomes emotional, right? And then you make decisions based on emotion, and that can be dangerous, right? Does that make sense? Set a plan if it actually trusts the company enough. I think that I think we, as a trader or investor in these companies, I don't think you want to get attached to any name. I think you want to, if things make you money, great. If they don't, move on. Um, I think it can be dangerous to just say I'm going to hold this company for 5 or 10 years. Um, you know, it's very difficult to predict the future, but it's hard to say you know so let's look at a company like Tesla, or we look at a company like Amazon. These are great companies. So Amazon, say we take Amazon at 3,000, $3,000 per share. Is Amazon going to be worth more in 10 years than it is now? You know, is that reasonable? Well, I can tell you there's been a history of companies that after 10 years, after 10 years from their peak, nobody knows when the peak is. They're nowhere near where they were. Um, so I think that just saying I'm going to buy and hold forever is a challenge. If you're going to buy and hold, I would say indexes like S&P 500 or the Nasdaq might be a way to go, and you can still do cover calls on those. You can still sell cover calls on those because the S&P and the Nasdaq are Nasdaq 100. They're managed by someone else, so they move companies out that don't continue to pay dividends. Um, you know, and put companies in that are paying dividends. So it's something that's managed that you don't have to worry about. Where you know any the internals of a company we don't really know unless you do the research, I guess. You know, the main thing, I guess, Rodrigo, is you got to have a plan. The main thing is you got to have a plan. Whatever it is, if you want to buy a stock, say this is my exit price, or I'm going to do cover calls every month, for as long as I own it. Some sort of plan of action. Just buying and holding, I don't think you should assume that you're going to make a ton of money. The less work we do, the less we typically make. What do you think if the portfolio is split into 4 areas? 25 for dividends, 25 for short-term trading, 25 for ETFs, 25 for covered calls. Yeah, you could do that. I mean, you can break that up any way you want. But if you're buying stock long term, why not do covered calls? When you say 25% for covered calls, how's that different than the stock we buy and we hold long term? The ones that we're trying to get dividends from. And short term, does that mean like weekly or daily? Is that what you mean? I want you to possibly consider, folks, get away from breaking up or developing a plan that way. just let's look at how much time we have to contribute to trading, and you know what the market's doing and what opportunities it's giving us. Sometimes I think it's quite expensive for some company to do covered calls like Amazon or Microsoft. Well, yeah, it could be, but you could do. I'll show you. So let me share my screen here and I'll explain what I mean. Um, so you said, let's see, you said like Amazon or Microsoft. Okay, let's look at Microsoft first. Okay. 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 So let's look at Microsoft. Okay. So Microsoft before, right? Let's say we wanted to look at doing covered calls, long term. So let's go January 21. Okay. All right. And let's say, we don't have to go. You know what? Actually, let's do shorter term. Let's go September. Okay. Now, what you can do is instead of buying the stock, Microsoft, what we can do is we can buy the call just deeper in the money. Okay, so deeper in the money. And the deeper we go, the less extra we're paying for the space. So to give you an example, let's go. Okay, so let's say that we do, let's go, maybe we go a little bit further. Let's go 90 days, okay? So let's go 90 days. So if we go 90 days and we go, say we go, it's trading at 204, let's go 50 in the money, okay? So 50. So if we buy Amazon, right now, we bought the call, the 150 call, we would pay an extra $1.20 for that premium of not buying the stock. Does everybody understand what I'm saying? So because the stock is trading at 204, yes, 204. If we go to 150, okay, what's it like buying? It's like buying a stock for $50 instead of 150. But we're going to pay a little bit of a premium. You see that? We're going to pay a little bit more than what it's worth. Does everybody understand that? Does that make sense to you? So instead of us buying the stock for 250, we're going to buy the stock. We're going to put up 50 bucks. That's the risk that we're putting up, 50 bucks instead of 250. Then we go 30 days out. Okay? 30 days out. 30 days out, and we sell the 40 delta. So the 40 delta is right closest to 40 is going to be that one. So we sell this right here. We sell. Okay? So we sell this one, and that's our trade. Okay? That's our trade. Now, if I hit transmit, I just want you to see the price. So what I have here is I bought Microsoft a call for at the 150 strike, and I sold 30 days out. 30 days out. Okay, I sold it 30 days out, and that total is going to cost me $49.65. Okay, $49.65. Now, let me show you on a whiteboard because I think that might be too complicated right now. Okay, for you. But let me explain. So if I go, so this is what we did. Microsoft, okay, is trading at 204. Okay, we bought the call, okay, the 150 call. Okay, how much did we pay for the 150 call? We paid, hold on one second, what did we pay for that one? we paid we went we paid $54. We paid $55.20. So we paid $55.20. Okay. So how much extra did we pay? So you take the stock, the call 150 plus this, and that tells us we paid how much? We paid $105.20. So how much extra did we pay? You got it. $1.20. Yes? That's what we paid. But what does that do for us by doing that? So instead of buying the stock itself, we're buying basically control of the stock for 90 days. I think it's 80 days actually. It's 80 days, 79 days. We buy control of the stock for 80 days, and we're only at risk $50 instead of the whole $204 that the stock's trading at. What it allows us to do is to get into something larger like that without buying the stock itself. Does that make sense? So instead of us, using, you're a bit lost. Okay. So if you bought Microsoft, okay. So if we buy Microsoft, how much is 100 shares of Microsoft going to cost? 100 shares at 204. It's going to cost you how much? There you go. 20,400. Okay. Now what is an option, the 150 option at 50, what was it? 55.20 per share times 100. What's that going to cost you? That's right. 55.20. That's what it's going to cost you. Okay? Now do you see, for you controlling it for 80 days, it's going to cost you an extra $1.20. So you're going to pay $1.20, but you're only going to put up $5,000 instead of $20,000. Does that make sense? Does that make sense to everybody? If anybody's lost, just say so. Or confused. We could, that's naked call, isn't it? No, if you buy the option, it's not naked. It's when you sell the option and you just sell the option, that's called naked, Henry. So when you buy an option, you're not naked, you're buying it. There's a limited risk, right? This is called defined risk. What's the defined risk? Well, we could lose all our money. If the stock dropped below, $50 or 150, we could lose all that money. But if you own the stock, you'd lose that money too, right? So I mean, the bottom line is you can control a stock that's much more expensive and pay a premium, an extra premium to do that instead of taking the whole risk of the stock. This is why, I wonder, what's the point of owning a stock at all? What's the point? So let's look at something like Amazon. So if we look at Amazon, could we do that with Amazon? Well, let's look. Now, what would 100 shares of Amazon cost you? What would 100 shares of Amazon cost you? Yeah, I know. Give me one sec. What would a 300K? So Amazon would cost you, 100 shares would cost you $300,000. Yeah, 300K. Okay, for 100 shares. Now let's see what we can do with Amazon. Let's see if we can make that work in a smaller account, right? Now mind you, Amazon's $3,000. It's a $3,000 account. $3,000 trade stock per share. Let's see what we can do well, if it's even makes sense doing it this way. But I'll show you a couple different options. Okay. Okay. So let's say we would like to look at Amazon. Okay. So Amazon, if we went, say, we go real far. Let's not go that far. Let's say we did same thing, 79 days. Okay. So could we do that? Could we do something with Amazon? Well, what if we went? Let's see. What if we bought the let's say 29s. So look what the 29s are charging you. Okay. So the 29s are charging you $2.99. So if the 29 is charging you $2.99 and the stock is trading at 3,046, how much extra are you paying? How much extra are you paying? $300K? No, no. If you're buying 2,900 strike for $300, right? $300. How much? Do you remember how we calculated that? You're paying $299, $300 a share. Just call it $300 a share. Okay, look. The stock is trading at, Amazon is trading at, so Amazon is trading at $3,046. Okay, that's what it's trading at. You're paying per share how much? You're paying the strike, so a call at what price did we say? 2,900. Okay, you have to pay how much? How much did we say? You're gonna have to pay $300. Okay, so if I add these together, 29 and 3, how much is that? Sorry, 3,200. Yes. Okay, so I'm paying 3,200. The stock's trading at 3,046. So I'm paying an extra how much? $154 per share. $154 per share. Okay? So you're paying $154 extra per share. $154. Okay? Now, that seems quite high, right? We're paying an extra $124. But remember, you're controlling a $3,000 stock for 90 days. And the most you can lose is the $3,200. The most you could lose is the $3,200, right? Sorry, is $3,000. It's actually 3,000 because it's 3,000 per share. Okay. Now, what if we also sold 30 days out, and we sold the 40 delta. The 40 delta, show you in a sec. 40 delta is 108, 101, so 101. So it'd be 101. So I could bring in 101 by selling a call. Okay, so how much am I paying now? How much extra am I paying now? If I bring in 101, so minus, I got to pay an extra 124, but I bring in 101 for 30 days. How much do I pay now? Now my cost is $53 extra. Okay, that makes sense to everybody? That makes sense? So now a $3,000 stock we're controlling for 300 bucks. We sell a call, and the call allows us to bring in 101. And by the way, that call is the 3160. 3160. It's trading at 3046. So 3160, we could bring in another extra if they took it away from us. If it actually went to 3160, and they took it away from us, we'd make an extra looks like $114. How much can you make? Well, you can make if somebody took it away from you in a month, you could make 114. So you'd make somewhere around 114, 53, 47, 50, 61. So $610. $610. No, that's wrong. I'm sorry. No. Yeah, per share. That's per share. No. 61 per share. 6,100 for the trade. Does that make sense? That's if it goes right up. Sam, help me understand the timing. We buy a call for 90 days, cover the call for 30 days. Yes. How do we cover this 30-day covered call? Well, you can buy 90 days and sell 30 days, right? Henry, just like we do with covered calls, right? With the stock, we buy the stock and we sell 30 days out. So if I'm looking at if I'm looking at 30 days out, so this is 30 days out, and I'm looking at the 40 delta, which is actually this one. Made a mistake there. It's this one. That's the 40 delta. So I go, let's do one at a time, okay? Let's go 90 days out, right there. Sorry, 80 days, 79 days actually. We can go further. I say, okay, I'm going to buy, and you know what? I'll just give you, follow the rules. What you're supposed to do is take at least the 60 delta, at least the 60 delta. Okay, so that's the one you could get, the 60 delta. But if we wanted to go deeper, we go deeper. Let's say we did this one, the 60 delta. So the 60 delta, we would buy this, and we go 30 days out, 30 days out, and we sell the 40 delta. So 30 days out, we sell the 40 delta, which is the 40 delta would be this one, 3170. So I'd sell that one. So I bought, here it is right up here. I bought 80 days out, and I sold 30 days. Does that make sense? So if I transmit that, it's going to cost me $163 per share. Does that make sense? Okay. So what happens is, and we'll look at this scenario. If we did the 60 delta and the 40 delta. Let's just stick to that, and let's see what happens. Okay. So does everybody understand what I just did, right? Everyone's clear on that? We got Amazon October 16th, 2960 call. We bought and we sold the Amazon August 28, 3170 call. Okay, everyone's clear? Okay, good. So let's look at the different scenarios of what could happen. Okay, so if let's go back here. So let's look at the different scenarios. Okay, so here we go. Stock's trading at $3,046. Okay, so let's say the stock goes up, and it goes up to the total price of $31.70. That's what it goes up to. Okay, it goes up to $31.70. Now remember, we paid how much? How much do we pay? We paid $163.62. That's what we paid. Okay, that's what we paid. That's our investment per share. Okay, now if it goes to 31.70 and we have the 29.60, I believe is what it was, right? 29.60. Yep, 29.60. What's the difference between these two? $210. Good. So the difference between these two is $210. So I bring in $210, right? But I paid $163. So what am I left with? $47. There you go. Per share. So 47 times 100, I make 4,700 on that trade. Does that make sense to everybody? That's if it goes up. Okay, good. All right. Now let's say that it stays the same. Stays at 30,000, 3,000, 47, sorry, 46, and it stays at 3,046. How much did I pay? I paid $163. That's what I paid. If the stock stays exactly where it is, what happens? Well, my 163, right, that I paid, the value of my option, what has happened? 30 days have gone by, yes? So if 30 days have gone by, it's lost some of its value, right? It's lost some of its value. How much is it lost? Well, I brought in that money, right? I brought in that 90, it was $98. I brought in $98, but I paid, second, this one so you can see it. I want you to see it, actually. I can show you a quick way to calculate it, a simple way to kind of get an idea of it, okay? Hold on. So what would that same thing be worth 30 days out? How would I do that? So the way I do it, an easy way to calculate, kind of look at what it's going to be worth, is what we do is we go instead of this one here, you can see this here, right? It's 98. That's what we can bring in, right? But what did we pay? We paid 79. We paid, say, 60 delta right there. How much did we pay? We paid 268, right? 268. Now, what would that look like 30 days? If 30 days expired? Well, what we can do is we can actually go to the 51. That's 30 days have gone by, basically. 30 days have gone by. And I look at the same price, 29.60. What does it say? What's it say? 229, yes? Everybody see that? 229? Okay, so 90 days out, 80 days out, it's worth 268. 30 days go by, right? Roughly 30 days. What's that same strike going to be worth? Well, it's going to be worth roughly this price. 229. Everybody see that? Because that's 30 days have gone by. You see what? Does everybody get what I'm doing there? Just 30 days. I've gone, okay, well, what if this thing is 30 days have gone by? What's that same option going to be worth? Well, if everything stayed exactly the same, right? Because we're saying if the price stays the same, right? So if the price stays exactly the same, I can assume that I'm going to be somewhere in this range. I'm going to be, the option that I bought is going to be worth 229. It's only going to be worth 229. So 229 is what it's going to be worth. What did I pay? 268. So what's the difference between that? Say it's 230 and 270. What's the difference? $40. Yeah, it's roughly $40, right? Now remember, I brought in how much? How much did I bring in from that short-term option? So I lost 40 on my long-term, but how much did I bring in from that long-term option if it stayed exactly the same? that short-term option, I sold for how much? 98 bucks. So if I sold it for 98 bucks, I brought in 98, call it 100. I brought in 100, but I lost 40. What's my net? I should assume what's going to happen. I'm up 60 bucks. Yes. Yes, I'm up 60 bucks. Does that make sense to everybody? Now these are rough numbers, right? They're not going to be exactly $60, but it's going to be roughly that amount. Okay, so I made $60 per share. So now I'm up 6 grand. You know, I'm up 6 grand on the trade if you look at it that way. Because 30 days have passed by. It's done nothing. Okay? Now what if, not bad, yeah. You still got to manage the trade though, right? You got an active trade. You're going to have to sell 30 days out again, right? We want to sell 30 days out again. You know? And the option that I bought is going to accelerate, you know, as time goes by, it's going to accelerate its losses, right? It's going to go from, you know, I only lost, you know, $40 at first, but I'll lose a lot more in the next month. Okay, so it has to be managed, but that's just to give you an idea. So if the stock stayed the same, we know we're gonna, you know, we'd make around $60 per share. Okay, if the stock goes down though, what happens then? So it's 3,046. Let's say it goes down to, what do you want it to go down to? How much? Give me a number. What do you think it, you know, it goes down in a month, it goes down to what? 2,800. So it goes down to 2,800. Okay? Now remember, what did I pay? How much did I pay? I paid how much? $229 is what I paid, right? $229, but I brought in how much? No, I didn't. Did I pay $229? My apologies. I want to double check that. No, not $229. That's what it would be. No. That's what it would be after 30 days. I paid more than $229. I paid 79 days. I paid $268, $270. Say $270. I paid $270, right? So I paid $270 for that option. Yes. Don't worry about this for now. Okay. $270 is what I paid. Yes. Okay. Now if the stock goes to 2,800, right? Is this going to be worth $270? Is it going to be worth $270? No, right? Because now I'm out of the money. I was in the money. Now I'm out of the money because I'm at 29.60. 29.60. What do you think that option would be worth if in 30 days it drops to $160 out of the money? Because remember, this call is the 29.60, right? So how far am I out of the money now? How much? Now it's 28. I'm 160 out of the money. Okay, so what would I expect that option to be worth? Well, I do the same thing, roughly. I go and I say, okay, what's it going to be worth? Well, if 30 days pass by, right? If 30 days pass by, give me 1 second. I'll show you. So if 30 days pass by, let's share my screen here. Okay. So what do? I go, okay, well, if 30 days pass by and I'm 160 out of the money, so what do? I say, okay, well, the current price is 145. If I add 160 to this to get to 160 out of the money, right? 160 out of the money, I would be around 3,200. Yes, 3,200. See, at 51 days, 30 days basically have gone by. I'm at 3,200. What's that one worth? 3,200 is worth how much? $126. Everybody see that? So my option will be worth still. It'll still be worth about 125 bucks. It'll still be worth 125 bucks. Everybody got that? Because I got still time on that, right? I still got 2 months. I still have 2 months. So it's roughly going to be worth 126 bucks at 30 days. Yeah, after 30 days have gone by. So remember, at 79 days, what was it worth? 79 days, it was worth 268. Call it 270. Now, 30 days have gone by. I'm out of the money 160 bucks. So that's like 3,200 from where it is now. Now, it's only worth 126. Call it 125 just to make it simple. Everybody got that? Everybody's clear on that, yes? Okay, so if that's true, let's work it out. Okay? So if that's true, I paid how much? I paid 200 and how much? 270. Okay, that's how much I paid. Now it's only worth how much? 125. So what did I take as a loss? $145. But now, so I lost 145. But what did I bring in from that option? Because that option's worthless too. How much did I bring into that option? Not 160. The one I sold. Remember the 30 days I sold? What was it worth? It was worth 100 bucks. Remember? 104. Call it 100 bucks. Call it 100 bucks to make it simple. So what's my net loss? $45. Everybody see that? Now remember, we're dealing with a $3,000 stock and we're able to still trade it, but you have to manage the trade. You have to manage it. But you can still trade that stock, you just have to trade it a specific way. But what can I do with that option now? What am I still allowed to do? I'm still allowed to do what? I have 60 days left. Sam, do you exercise this at all, or just sell it the day before expiration? Yeah, you're not gonna call away the stock if you can, because the stock's $3,000 a share. You see what I'm saying? I mean, that's the whole idea, is not to own the stock. So you're not gonna call this thing away if you can. Right? You see that, right? So best to do it the day before. Well, it could be the day before, a week before, or 2 weeks before. I would say that you probably, in this kind of trade, you probably want to sell it, 30 days out. 21 days, I'd say, is probably the longest you'd want to wait. I'd say do it for 2 months and then get rid of it. Do it for 2 months and get rid of it to be safe. Because in the last 30 days, that thing's gonna go down fast. 30 days. If you own it and you're selling it, and you have, say, 90 days, do it for 2 months, get rid of it the last 30 days. Because the last 30 days is when it loses value the fastest. Remember we talked about the curve? How about the call option is what we're talking about. You would sell the call option that you own. I'll tell everybody this. Okay, let's do this. Okay, let's just do this. It's best just to do it. Okay, so I don't mean this with real money. Obviously, I'm talking about using paper trading accounts. Okay, so let's put the trade in. How about we do that? How about we do that, folks? How about we put the trade in and we monitor it? How's that sound? Okay. Now, typically, we wouldn't do this with this. We wouldn't do this with this because its earnings are going to be reported tomorrow. But let's do it anyways. Who cares? Okay. So let's go. Let's do it. Let's buy the October 16, 20, 29.60 and sell the 30 days out, 31.70, and let's do this trade. Okay. So let's transmit this trade. And let's see what happens. How's that sound? Does that sound good to everybody? There. And we'll see what happens. Let's see what happens. Then we'll do trade management on it, okay? So we just transmitted the trade. Now tomorrow, it's not going to trigger till tomorrow. So tomorrow, it might not trigger. We'll see if it triggers. Tomorrow, it won't let us pay more than 163.62 for that trade. So let's see what happens. We put in the trade. Let's see what happens, and we'll manage the trade over the next few weeks, okay? And then we can see actually how it happens, okay? Sound good? Okay, good, good. All right, any questions before we wrap up? I think because I'm using Questrade that it confused me. No worries, no worries. Different platforms, it looks different. Yeah, I totally understand that. Okay, we're gonna wrap up, folks. It's 8. Sorry, it's 9. Any questions? Let's see how it goes, Henry. Right? We'll run with this trade and see what happens. Because on October 16th, I would have to buy or exercise that call. What do you mean? You mean the one we sold or the one we bought? The one we bought, that's why I'm confused to what the expiration date is. The expiration date was, the one we bought, the expiration was October 16th. Yeah, you're right. So the one we own is October 16th. So on October 16th, if this was in the money, we'd have to close it out. If it was out of the money, we'd have to do nothing. But if it's in the money, we'd have to close it out, or someone's going to put the stock to us. You'd have to have the money in your account. And I'll tell you what your broker would do automatically. Like many brokers will just close it out for you. They won't even let you do it because you don't have the money to actually take the stock on. Okay? Automatically, yeah. Automatic. Well, if it's out of the money, it's worthless anyways. But if it's in the money, they'll close it out for you, and you'll take some profit on that, hopefully. All right, let's see how this one goes. Any questions before we wrap up? Okay, good. If you're good, type in yes or Y. Okay, I'll put this recording up, folks, so you can see it in the next couple days. You'll be able to review it, okay? I know that was a lot to cover, but let's continue to, yeah, no worries, my pleasure. Let's continue to do that. Okay, folks, everybody on the call, we're going to try a Zoom call next week, okay? So everybody get Zoom. We're going to try a Zoom call next week. All right? Everybody okay with that? So we'll start with this, okay? I'm going to open up with this, give you the link from here to make sure everybody makes it here, and then we'll do the Zoom, okay? All right? All right, folks. Okay, everybody have a great week. If you have any questions before we meet next week, you can just email me, okay?